Analyzing economic indicators for construction risk forecasting requires a multidimensional approach that bridges macroeconomic theory, practical application, and real-world impacts on the surety bond industry. At its core, the process begins with identifying the key macroeconomic indicators that influence construction projects. Among these, gross domestic product growth, inflation rates, and interest rates are particularly critical. Gross domestic product, often referred to as the most comprehensive measure of a country's economic health, serves as a barometer for the construction industry's overall vitality. Periods of robust gross domestic product growth often correlate with increased demand for new construction, spurred by private sector investment, government infrastructure initiatives, and a surge in consumer spending on housing. Conversely, a contraction in gross domestic product signals reduced construction activity, often precipitated by declining investments, budgetary constraints, and shifts in consumer confidence. These patterns, when analyzed over time and across regions, provide underwriters with insights into potential fluctuations in demand for construction-related surety bonds. Inflation, another critical macroeconomic variable, exerts both direct and indirect pressure on construction projects. High inflation rates drive up material costs, labor expenses, and overall project budgets, often resulting in delays or project terminations. Moreover, inflation tends to erode purchasing power, which can lead to decreased capital availability for developers and contractors. For underwriters, understanding how inflation affects specific construction markets is essential. For example, rising costs in materials like steel or lumber may disproportionately impact contractors specializing in commercial projects, while residential contractors may face different inflationary pressures tied to consumer mortgage affordability. Historically, inflationary spikes in the late 1970s and early 1980s led to widespread construction project cancellations, leaving surety underwriters grappling with an unprecedented wave of claims. These historical instances underscore the importance of integrating inflation trend analysis into modern risk models. Interest rates, closely tied to inflation and monetary policy, are equally pivotal in shaping construction risks. Lower interest rates generally stimulate construction activity by reducing the cost of borrowing, enabling contractors to secure funding for large-scale projects. However, in periods of rising interest rates, the cost of capital increases, often slowing down new construction starts and pressuring contractors with existing debt. The Federal Reserve's monetary tightening cycles, such as those observed in the early 1990s and during the post-2008 financial recovery, provide valuable case studies. During these periods, contractors heavily reliant on credit experienced significant financial strain, leading to increased project defaults and subsequent claims on surety bonds. These dynamics illustrate the critical need for underwriters to evaluate interest rate trends and their implications for contractor liquidity and solvency. To correlate these macroeconomic trends with contractor performance risk, underwriters employ a variety of analytical frameworks. One common method involves the use of economic scorecards, which aggregate regional economic indicators such as unemployment rates, housing starts, and infrastructure investment levels. By comparing these indicators against historical contractor performance data, underwriters can identify patterns of vulnerability. For instance, a region experiencing high unemployment and declining housing starts may signal reduced contractor opportunities and increased competition, heightening the risk of aggressive bidding practices that could lead to financial overextension. Similarly, infrastructure investment data can provide insights into long-term project pipelines, allowing underwriters to anticipate regional shifts in demand for surety bonds. Case studies from recent economic downturns further illustrate the practical application of these analyses. During the 2008 global financial crisis, the construction industry experienced a sharp contraction as financing dried up and project pipelines evaporated. Contractors who had over-leveraged themselves in the pre-crisis boom faced widespread insolvencies, leading to a surge in surety bond claims. Notably, regions heavily reliant on residential construction, such as parts of Florida and Nevada, were disproportionately affected due to the collapse of the housing market. In these cases, underwriters who had integrated local economic data into their risk assessments were better positioned to adjust their bond terms, pricing, and capacity limits to mitigate losses. Similarly, the COVID-19 pandemic disrupted global supply chains and labor markets, causing project delays and cost overruns. Contractors with diversified portfolios and strong liquidity were better able to weather these challenges, highlighting the importance of financial resilience as a key underwriting criterion. Interdisciplinary connections further enhance the depth of economic analysis in construction risk forecasting. For example, integrating insights from behavioral economics can help underwriters understand how contractor decision-making is influenced by economic uncertainty. Contractors may take on riskier projects during downturns to maintain cash flow, a behavior that can exacerbate default risks. Additionally, advancements in data science and machine learning are revolutionizing the field by enabling the analysis of complex data sets, such as regional economic trends and contractor performance metrics, to identify subtle risk signals. Predictive modeling tools, powered by artificial intelligence, allow underwriters to simulate various economic scenarios and their potential impacts on contractor portfolios, providing a more nuanced understanding of risk. Contemporary debates in the field focus on the balance between leveraging quantitative models and maintaining the role of qualitative judgment. While data-driven approaches offer precision and scalability, critics argue that they may overlook context-specific factors such as contractor reputation, management quality, and adaptability. For instance, a contractor with a long history of successfully navigating economic downturns may present lower risk despite operating in a challenging market environment. This debate underscores the need for underwriters to adopt a holistic approach, combining quantitative tools with expert judgment to capture the full spectrum of economic risks. The continuous evolution of economic conditions requires an adaptive approach to construction risk forecasting. By combining historical insights, advanced analytical methods, and interdisciplinary perspectives, underwriters can develop more robust models that anticipate and mitigate the complex interplay of macroeconomic factors on contractor performance and surety bond outcomes. This ongoing refinement ensures that underwriters remain equipped to navigate the dynamic landscape of construction risk, safeguarding both their portfolios and the broader stability of the construction industry. Labor market dynamics are a critical determinant of contractor viability, exerting profound influence on project timelines, costs, and overall performance. The modern construction industry operates within a labor environment shaped by complex factors such as demographic trends, immigration policies, economic cycles, and technological advancements. Labor shortages, in particular, have become a defining challenge, exacerbated by aging workforces, declining vocational training programs, and the increasing demand for skilled labor in a competitive market. These shortages lead to cascading effects on project schedules, with contractors struggling to allocate adequate human resources to meet deadlines. Delays caused by insufficient labor often result in increased project costs due to penalties, extended overheads, and accelerated schedules to recover lost time. Additionally, the scarcity of skilled trades such as electricians, welders, and heavy machinery operators can lead to inflated wage demands, further straining contractor budgets and compressing profit margins. To evaluate the workforce stability of a contractor, underwriters must consider both internal and external factors influencing labor availability. Internally, the contractor's ability to retain and develop a stable workforce is paramount. Contractors with high employee turnover rates are more vulnerable to project disruptions, as frequent onboarding of new workers hampers productivity and increases the risk of errors. Workforce stability can be assessed through metrics such as employee retention rates, training programs, and the existence of formalized career development pathways. Contractors that invest in upskilling and certification programs for their employees demonstrate a forward-thinking approach to labor management, reducing their dependency on external markets for skilled workers. Furthermore, the quality of management within a contractor's organization plays a pivotal role. Strong project managers and foremen who foster a culture of accountability and professionalism contribute significantly to workforce cohesion and performance. Externally, the reliance on subcontractors introduces an additional layer of risk. Subcontractor networks are integral to the construction industry, often filling gaps in a contractor's workforce for specialized tasks or when demand exceeds in-house capacity. However, over-reliance on subcontractors can expose contractors to vulnerabilities such as inconsistent quality, scheduling conflicts, and financial instability. Evaluating a contractor's subcontractor relationships involves analyzing the stability and reliability of their partners. Factors such as subcontractor financial health, project history, and capacity constraints should be scrutinized. Additionally, underwriters must assess the contractor's ability to manage these relationships effectively, ensuring that subcontractors adhere to project timelines and deliverables without compromising overall quality. The assessment of labor market risks also necessitates the use of advanced tools and methodologies to analyze regional labor dynamics. Geographic location significantly impacts the availability of skilled labor, as certain regions may experience acute shortages due to population decline, limited vocational training institutions, or economic migration. Conversely, other areas may benefit from robust labor pools supported by strong local economies and educational infrastructure. Underwriters can leverage labor market data from sources such as the Bureau of Labor Statistics, local employment agencies, and industry trade associations to identify trends and forecast workforce availability. These datasets provide insights into unemployment rates, wage growth, job vacancy rates, and sector-specific employment levels, enabling a granular understanding of labor market conditions. Predictive analytics further enhance workforce risk assessment by modeling potential scenarios based on historical data and economic indicators. For instance, during periods of economic expansion, increased competition for labor from other industries such as manufacturing and logistics may lead to construction workforce shortages. Predictive tools can simulate these scenarios, allowing underwriters to anticipate and mitigate risks associated with labor competition. Additionally, these tools can incorporate demographic trends, such as the aging workforce in construction, to highlight long-term risks. Research indicates that a significant portion of the skilled construction workforce is nearing retirement age, underscoring the importance of workforce development initiatives to sustain labor supply. Interdisciplinary connections enrich the analysis of labor market dynamics by integrating perspectives from economics, sociology, and organizational behavior. Economic theories of labor supply and demand provide foundational insights into wage-setting mechanisms and the elasticity of labor markets. For example, inelastic labor supply in skilled trades means that even small increases in demand can lead to significant wage inflation. Sociological perspectives, on the other hand, shed light on workforce demographics, including the role of immigration in supplementing labor shortages. Historically, immigration has been a critical factor in sustaining the construction workforce, particularly in regions with high demand. However, shifting immigration policies and political climates create uncertainty, compelling contractors and underwriters to adapt their strategies. Organizational behavior contributes to understanding the human factors affecting workforce stability, such as job satisfaction, leadership styles, and the impact of workplace culture on employee retention. Historical context further deepens the understanding of labor market dynamics. For example, the construction boom of the mid-2000s, fueled by housing demand and infrastructure investments, exposed significant labor shortages as the industry struggled to scale up its workforce. The subsequent 2008 financial crisis reversed this trend, leading to widespread layoffs and an exodus of skilled workers from the industry. Many of these workers did not return when the market recovered, creating a structural imbalance that persists today. These historical patterns illustrate the cyclical nature of labor market challenges and the importance of long-term workforce planning. Contemporary debates in the industry revolve around the role of technology in addressing labor shortages. Automation and prefabrication are often touted as solutions to reduce dependency on human labor, with advancements in robotics enabling tasks such as bricklaying, welding, and material transport to be performed with greater efficiency. However, critics argue that technology cannot fully replace the craftsmanship and adaptability of skilled workers, particularly in complex projects requiring bespoke solutions. Additionally, the adoption of technology introduces its own challenges, such as the need for specialized training and the upfront costs associated with implementation. This debate underscores the need for a balanced approach, where technology complements human labor rather than displacing it entirely. The multifaceted nature of labor market dynamics requires underwriters to adopt a holistic perspective, integrating quantitative data, qualitative judgment, and interdisciplinary insights. By continuously refining their methodologies and leveraging innovative tools, underwriters can navigate the complexities of workforce risks, ensuring that contractor viability is assessed with precision and depth. This approach not only mitigates potential losses, but also supports the long-term sustainability of the construction industry as it adapts to an evolving labor landscape. Material cost volatility presents one of the most significant challenges in assessing construction risks, and its intricate relationship with global supply chains demands a comprehensive analysis. At the core of this issue lies the interdependence of supply chain networks, which span continents, industries, and geopolitical landscapes. The construction industry is particularly vulnerable to disruptions in these networks due to its reliance on raw materials such as steel, cement, copper, lumber, and petroleum-based products. Global supply chains are influenced by a complex interplay of factors, including international trade policies, transportation logistics, currency fluctuations, and the availability of raw materials in producer nations. Any disruption, whether caused by natural disasters, political instability, trade embargoes, or technological breakdowns, can send shockwaves through these networks, resulting in significant cost escalations for construction materials. To understand the role of global supply chains in material cost fluctuations, it is essential to examine the dynamics of supply and demand within commodity markets. For example, the price of steel is heavily influenced by production levels in major exporting countries such as China and India, as well as global demand for infrastructure and manufacturing. A reduction in output due to environmental regulations or energy shortages in these regions can create a ripple effect, driving up prices worldwide. Similarly, timber markets are affected by deforestation policies, wildfires, and pest infestations, which reduce supply while demand for residential and commercial construction continues to grow. The dependence of construction on these global networks creates an inherent vulnerability, as contractors often have limited ability to source alternative materials or mitigate cost increases in the short term. Forecasting commodity price volatility requires a multifaceted approach that integrates economic modeling, historical trend analysis, and real-time market data. One effective method is the use of commodity futures markets, where prices reflect market expectations of future supply and demand. By analyzing futures prices for materials like copper, aluminum, and crude oil, underwriters can gain insights into potential cost increases that may impact construction projects. Historical trend analysis further enhances this understanding by identifying patterns of price volatility during specific economic conditions, such as recessions, trade disputes, or periods of rapid industrial growth. For instance, during the 2008 global financial crisis, sharp declines in construction demand caused a temporary collapse in commodity prices, followed by a dramatic rebound as governments invested in infrastructure projects to stimulate economic recovery. These historical cycles provide valuable context for predicting future price movements. In addition to market-based approaches, forecasting must consider geopolitical and environmental factors that influence material availability. Trade policies, such as tariffs and export restrictions, can drastically alter the cost landscape. The United States' imposition of steel and aluminum tariffs in 2018, for example, led to a significant rise in domestic construction costs as contractors were forced to absorb higher material prices. Environmental concerns, including climate change and resource depletion, also play a critical role. The transition to sustainable construction practices has increased demand for eco-friendly materials, further straining traditional supply chains. These factors underscore the importance of a holistic forecasting framework that accounts for economic, political, and environmental variables. The impact of material cost volatility on project costs is both immediate and far-reaching. Rising material prices increase the baseline costs of construction projects, often forcing contractors to renegotiate contracts, seek alternative suppliers, or adjust project timelines. Cost overruns are particularly common in fixed-price contracts, where contractors bear the risk of price increases after the contract has been signed. These overruns can erode profit margins, delay project completion, and, in extreme cases, lead to contractor insolvency. Underwriters must account for these risks by closely examining contractors' pricing strategies, procurement practices, and financial resilience. Contractors with strong relationships with suppliers and access to bulk purchasing agreements are better positioned to manage cost volatility, reducing their risk profile from an underwriting perspective. Building contingency buffers for high-risk materials is a critical strategy in mitigating the financial impact of cost volatility. These buffers involve allocating additional funds within project budgets to cover unforeseen cost increases. The size of the contingency depends on several factors, including the volatility of specific materials, the duration of the project, and the contractor's procurement strategy. For instance, projects with a heavy reliance on steel and concrete, such as bridges and high-rise buildings, may require larger contingencies due to the historical price fluctuations of these materials. Conversely, projects with shorter timelines or lower material intensity may allocate smaller contingencies. Effective buffer planning also requires a dynamic approach, with regular adjustments based on real-time market conditions and supplier feedback. Underwriters play a crucial role in evaluating the adequacy of these contingency buffers during the risk assessment process. This evaluation involves examining the contractor's cost estimates, contingency plans, and financial capacity to absorb unexpected cost increases. Contractors who demonstrate a proactive approach to managing material risks, such as locking in prices through long-term supplier agreements or using financial instruments like hedging, are better equipped to handle volatility. Hedging strategies in particular allow contractors to mitigate price risk by entering into forward contracts or options that lock in future purchase prices for key materials. While these strategies require financial expertise and upfront costs, they provide a valuable risk management tool for high-risk projects. Interdisciplinary perspectives further enrich the analysis of material cost volatility by connecting construction risk assessment to broader economic, environmental, and technological trends. Supply chain theories, such as the bullwhip effect, highlight how small changes in demand can lead to exaggerated fluctuations in material supply, creating inefficiencies and cost increases. Environmental economics provides insights into the long-term sustainability of material resources, emphasizing the need for alternative materials and recycling to reduce dependence on volatile commodity markets. Technological advancements, such as blockchain for supply chain transparency and artificial intelligence for predictive analytics, offer innovative solutions to manage and forecast material risks. Contemporary debates in the field focus on the balance between cost efficiency and resilience in supply chain management. While cost-efficient procurement practices prioritize low prices and just-in-time delivery, they often leave contractors vulnerable to supply chain disruptions. Resilient supply chains, on the other hand, emphasize diversification, redundancy, and strategic stockpiling to mitigate risk, albeit at a higher cost. This trade-off is particularly relevant in the wake of recent global events, such as the COVID-19 pandemic and the Russia-Ukraine conflict, which exposed the fragility of international supply chains and highlighted the need for greater resilience. The debate underscores the importance of adaptive strategies that balance cost efficiency with risk mitigation, ensuring that contractors can navigate the complexities of material cost volatility while maintaining project viability. The continuous evolution of supply chain dynamics and commodity markets necessitates an ongoing refinement of risk assessment methodologies. By integrating historical insights, advanced forecasting tools, and interdisciplinary approaches, underwriters can develop a nuanced understanding of material cost volatility and its implications for construction projects. This knowledge enables them to better anticipate risks, support contractor resilience, and ensure the stability of construction portfolios in an increasingly unpredictable global environment. Regional market trends and construction industry cycles are integral to understanding the underlying dynamics of construction risk and contractor viability. Local construction markets exhibit distinct cyclical patterns driven by economic, demographic, and policy-related factors. These cycles often reflect the broader economic environment, but are amplified or mitigated by regional characteristics such as population growth, labor availability, and investment in infrastructure. Identifying and assessing these patterns requires a deep understanding of the interconnections between real estate markets, infrastructure development, and commercial construction activity. The cyclical nature of construction markets is closely tied to supply and demand imbalances, financing conditions, and shifts in public and private sector priorities. For underwriters, recognizing these patterns enables the anticipation of risk, the adjustment of bond terms, and the calibration of exposure to specific regional markets. At the heart of regional construction cycles are the phases of expansion, peak, contraction, and recovery, which parallel traditional economic cycles but often exhibit unique timing and intensity. During periods of expansion, strong economic growth drives demand for residential and commercial construction, bolstered by population increases, urbanization, and access to affordable financing. This phase is characterized by rising property values, increased permit issuance, and heightened competition for contractors. However, as markets approach their peak, rising costs, labor shortages, and overbuilding risks begin to emerge. These pressures often trigger a contraction phase, during which construction activity declines, projects are delayed or canceled, and contractor defaults may rise. Recovery, marked by renewed investment and gradual stabilization, follows. But the speed and sustainability of this phase vary significantly across regions based on underlying economic fundamentals. Integrating regional real estate, infrastructure, and commercial project trends into underwriting requires the systematic analysis of market drivers and their impact on construction demand. Real estate trends, particularly in residential and multifamily housing, provide critical insights into market health. For instance, rising housing prices and low inventory levels often signal strong demand for new construction, whereas price stagnation or declines may indicate oversupply or weakening market conditions. Similarly, commercial real estate trends, such as office space absorption rates and retail vacancy levels, influence demand for commercial construction. Infrastructure investments, often driven by public sector initiatives, create additional opportunities, particularly in regions with significant funding for transportation, utilities, and public facilities. These trends must be evaluated in conjunction with demographic shifts, such as population growth or migration patterns, which shape long-term demand for housing and infrastructure. Leveraging local market intelligence networks enhances the accuracy and timeliness of risk detection by providing real-time insights into regional market conditions. These networks, comprising industry associations, government agencies, and private sector stakeholders, serve as invaluable resources for monitoring permitting activity, project announcements, and contractor performance. For example, local building departments provide data on construction permits and inspections, offering early indicators of market activity and potential risks. Industry trade groups, such as the Associated General Contractors of America, offer detailed reports on labor trends, material costs, and contractor sentiment. By engaging with these networks, underwriters can gain a nuanced understanding of regional dynamics, enabling proactive adjustments to risk assessments and bond pricing. Historical context further underscores the importance of regional analysis in construction risk management. The housing market crash of 2008 highlighted the stark regional disparities in market resilience. States such as Nevada, Florida, and Arizona, which experienced rapid pre-crisis expansion fueled by speculative investment, faced severe contractions as property values plummeted and construction activity collapsed. In contrast, regions with more stable demand drivers, such as the Midwest and parts of the Northeast, exhibited greater resilience. These historical lessons emphasize the need for underwriters to differentiate between speculative and fundamentally driven growth when assessing regional markets. Theoretical frameworks, such as location theory and urban economics, provide additional tools for analyzing regional construction trends. Location theory examines the spatial distribution of economic activity, highlighting the importance of proximity to resources, labor markets, and transportation networks in shaping construction demand. Urban economics, on the other hand, explores the interplay between land use, population density, and infrastructure investment, offering insights into long-term growth trajectories. For instance, regions with well-developed transportation systems and access to skilled labor are more likely to attract commercial and industrial projects, reducing the volatility of construction cycles. Contemporary debates in the field focus on the role of public policy and private sector investment in shaping regional construction trends. Infrastructure spending, often seen as a stabilizing force during economic downturns, is subject to political and budgetary constraints that can limit its effectiveness. Similarly, the growing influence of private equity and institutional investors in real estate markets has introduced new dynamics, including the concentration of capital in high-growth regions and the potential for speculative bubbles. These debates highlight the complexity of regional construction markets and the need for a balanced approach that considers both opportunities and risks. The integration of advanced analytics and technology further enhances the ability to assess regional construction cycles. Geographic information systems, for example, allow for the visualization of market trends and the identification of high-growth areas, while machine learning algorithms analyze historical data to predict future market behavior. These tools enable underwriters to quantify risk with greater precision, incorporating variables such as construction density, economic diversification, and infrastructure quality into their models. Interdisciplinary perspectives deepen the understanding of regional market trends by connecting construction risk analysis to broader social, economic, and environmental considerations. For example, sociological studies of urbanization patterns provide insights into the drivers of population growth and housing demand, while environmental science highlights the impact of climate change on construction practices and material availability. By integrating these perspectives, underwriters can develop a more comprehensive view of regional construction dynamics, ensuring that risk assessments are both rigorous and contextually informed. The continuous evolution of regional markets and construction industry cycles requires an adaptive approach to risk management. By combining historical insights, theoretical frameworks, and practical applications, underwriters can navigate the complexities of regional construction trends, aligning their strategies with the unique characteristics of local markets and ensuring the stability of their portfolios in an ever-changing landscape. Advanced risk modeling through economic stress testing is a critical process for evaluating the resilience of contractors and their projects under adverse economic conditions. At its core, stress testing involves the design of hypothetical scenarios that simulate economic downturns, enabling underwriters to assess how contractors' financial health, project viability, and overall risk profiles would be affected. This process begins with the identification of key economic variables, such as gross domestic product contraction, rising interest rates, inflation surges, and disruptions in credit markets, which have historically led to construction industry downturns. By integrating these variables into tailored stress scenarios, underwriters can evaluate the direct and cascading impacts of economic shocks on contractors' operational capacity, cash flow stability, and ability to meet financial obligations, including those covered by surety bonds. The design of stress test scenarios requires a nuanced understanding of both macroeconomic trends and the specific characteristics of the construction industry. Historical downturns, such as the 2008 global financial crisis, provide a foundational basis for scenario development. During that period, credit markets tightened, demand for new construction plummeted, and contractors faced significant challenges in maintaining liquidity and project schedules. These conditions led to widespread contractor defaults and a surge in surety bond claims, highlighting the importance of robust risk assessment frameworks. Stress test scenarios must also account for industry-specific dynamics, such as material cost volatility, labor shortages, and subcontractor reliability, which often exacerbate the effects of broader economic downturns. For example, a stress scenario might model the simultaneous impacts of a 30% increase in material costs, a 20% reduction in available labor, and a 10% decline in project demand, offering a comprehensive view of risk exposure. Combining project cash flow analysis with stress test outcomes is a crucial step in refining bond pricing and terms. Cash flow analysis evaluates a contractor's ability to generate sufficient revenue to cover operational expenses, debt obligations, and contingency reserves under normal conditions. However, when subjected to stress scenarios, these cash flow projections often reveal vulnerabilities that may not be apparent during stable economic periods. For instance, A contractor heavily reliant on short-term credit facilities might face liquidity constraints if interest rates rise or if lenders reduce credit availability during an economic downturn. Similarly, contractors with significant exposure to fixed-price contracts may struggle to absorb material cost increases, resulting in project delays or defaults. By integrating stress test results into cash flow models, underwriters can quantify the potential financial strain on contractors and adjust bond terms, such as pricing, collateral requirements, or coverage limits, to mitigate associated risks. The practical application of financial software tools for economic scenario modeling enhances the precision and efficiency of stress testing. Modern financial platforms, such as Monte Carlo simulation tools, enable underwriters to model thousands of potential scenarios, capturing a wide range of economic conditions and their probabilities. These tools incorporate advanced statistical techniques to evaluate the interplay between variables, such as the correlation between inflation and interest rates, or the impact of global trade disruptions on material costs. Additionally, machine learning algorithms can analyze historical data to identify patterns and predict contractor behavior under stress conditions, providing deeper insights into risk factors. For example, an artificial intelligence-driven model might identify contractors with a history of delayed payments during previous downturns, flagging them as higher risk in current assessments. Interdisciplinary connections further enrich the stress testing process by integrating perspectives from economics, behavioral finance, and risk management theory. Macroeconomic models, such as the ISLM framework, offer insights into how changes in monetary policy influence credit availability and interest rates, key drivers of construction risk during downturns. Behavioral finance highlights the tendency of contractors to overextend during periods of economic expansion, leaving them vulnerable when conditions deteriorate. Risk management theory, particularly the concept of systemic risk, underscores the interconnectedness of contractors, suppliers, and financial institutions, illustrating how localized failures can propagate through the industry during economic stress. The historical context of stress testing reveals its evolution as a critical tool in financial risk management. Initially developed in the banking sector to evaluate the resilience of financial institutions, stress testing gained prominence following the 2008 crisis, when regulators mandated its use to assess systemic stability. In the context of surety underwriting, stress testing has become increasingly sophisticated, incorporating industry-specific variables and real-time data to address the unique challenges of the construction sector. For example, during the COVID-19 pandemic, stress tests were adapted to model the impacts of supply chain disruptions, labor shortages, and project cancellations, enabling underwriters to respond proactively to an unprecedented risk environment. Contemporary debates in the field focus on the balance between model complexity and practical application. While highly detailed models offer greater accuracy, they often require significant data inputs and computational resources, which can limit their accessibility for smaller underwriting teams. Critics argue that overly complex models may obscure key insights or introduce errors due to the limitations of underlying assumptions. Proponents, however, emphasize the value of granular analysis in capturing the nuances of contractor risk, particularly in volatile economic conditions. This debate underscores the importance of aligning model complexity with the specific needs and capabilities of the underwriting team, ensuring that stress testing remains both rigorous and actionable. The integration of stress testing with broader risk management strategies offers a holistic approach to underwriting. For instance, results from stress scenarios can inform decisions on portfolio diversification, ensuring that exposure to high-risk contractors or regions is balanced by investments in more stable markets. Additionally, stress testing can guide the development of contingency plans, such as pre-arranged credit facilities or material procurement agreements, to support contractors during economic downturns. These strategies not only mitigate risk, but also enhance the overall resilience of the construction industry, enabling contractors to navigate economic challenges more effectively. As economic conditions continue to evolve, stress testing remains an essential tool for identifying and managing construction risk. By leveraging advanced modeling techniques, historical insights, and interdisciplinary frameworks, underwriters can refine their assessments, align bond terms with risk profiles, and support the long-term stability of their portfolios in an increasingly dynamic and uncertain global environment. Evaluating a contractor's adaptability in changing economic conditions is a multifaceted process that combines historical performance analysis, qualitative judgment, and quantitative tools to assess how well contractors can navigate challenges such as cost inflation, labor shortages, and fluctuating market demand. Adaptability, in this context, refers to the contractor's capacity to adjust operational strategies, financial practices, and resource allocation to maintain project viability and financial stability under economic stress. This adaptability is a critical factor in underwriting decisions, as contractors who can effectively respond to economic pressures are less likely to default on obligations, reducing the risk exposure of surety providers. Methods for assessing adaptability begin with a comprehensive evaluation of the contractor's operational structure and decision-making processes. A contractor's ability to manage cost challenges, for example, often hinges on their procurement strategies, including long-term supplier agreements, bulk purchasing capabilities, and the use of financial instruments such as hedging to stabilize material prices. Contractors who proactively secure price locks for high-risk materials, such as steel or concrete, demonstrate foresight and risk management acumen, which are strong indicators of adaptability. Similarly, assessing labor adaptability requires examining workforce management practices, such as the contractor's ability to recruit and retain skilled labor, leverage subcontractor networks, and implement training programs to upskill workers. Contractors who maintain flexible staffing models, including the use of temporary or project-based labor, are better positioned to scale their workforce in response to changing project demands and economic conditions. Historical performance analysis is another key component in evaluating contractor adaptability. Reviewing a contractor's track record during previous economic downturns or periods of high inflation provides valuable insights into their resilience and decision-making under pressure. For instance, contractors who maintained stable financial performance during the 2008 financial crisis or the inflationary spikes of the 1970s likely possess robust risk management practices and operational flexibility. Specific metrics to analyze include profit margins, cash flow stability, debt-to-equity ratios, and project completion rates during these periods. Additionally, qualitative factors, such as the contractor's ability to renegotiate contracts, secure additional funding, or pivot to alternative markets, offer further evidence of adaptability. For example, a contractor who successfully transitioned from residential to commercial projects during a housing market downturn demonstrates strategic agility that mitigates exposure to sector-specific risks. Developing scorecards to rank contractor resilience under economic stress provides a structured approach to synthesizing these diverse factors into actionable insights. A well-designed scorecard incorporates both quantitative metrics and qualitative indicators, allowing underwriters to compare contractors systematically. Quantitative metrics might include liquidity ratios, net working capital, and historical variance in profit margins during economic downturns, while qualitative indicators could assess leadership quality, strategic planning capabilities, and the robustness of contingency plans. For instance, a contractor with strong liquidity and a history of maintaining profit margins despite rising material costs would score highly on financial resilience. Similarly, a contractor with a documented history of proactively addressing labor shortages through training programs or partnerships with vocational institutions would score well on workforce adaptability. The inclusion of weighted criteria ensures that the scorecard reflects the relative importance of each factor based on the specific economic context and project requirements. Interdisciplinary frameworks further enrich the evaluation process by integrating perspectives from economics, organizational behavior, and strategic management. Economic theories, such as the adaptive expectations hypothesis, provide insights into how contractors anticipate and respond to changes in inflation or interest rates, shaping their procurement and pricing strategies. Organizational behavior studies highlight the role of leadership and corporate culture in fostering adaptability, emphasizing the importance of decision-making speed, communication, and collaboration during periods of economic uncertainty. Strategic management theories, such as resource-based view, underscore the importance of a contractor's tangible and intangible assets, such as financial reserves, skilled labor, and reputation, in determining their capacity to adapt to external pressures. The historical context of adaptability assessments reveals their evolving significance in construction risk management. During the post-World War II era, the rapid expansion of infrastructure projects highlighted the importance of adaptability as contractors faced shortages of materials and labor. Similarly, the stagflation of the 1970s underscored the need for robust procurement and financial strategies to manage unprecedented inflationary pressures. More recently, the COVID-19 pandemic provided a real-time stress test for contractors, with disruptions to supply chains, labor markets, and project financing exposing significant variations in resilience across the industry. These historical examples illustrate the critical role of adaptability in mitigating the financial and operational risks associated with economic volatility. Contemporary debates in the field focus on the balance between adaptability and specialization. While adaptability is often viewed as a universal strength, some argue that excessive flexibility may dilute a contractor's core competencies, reducing efficiency and profitability in their primary market. Conversely, contractors who overly specialize may struggle to pivot during economic downturns, leaving them vulnerable to sector-specific risks. This tension highlights the importance of strategic balance, where contractors maintain sufficient adaptability to manage external shocks without compromising their competitive advantages. The use of technology and data analytics further enhances the evaluation of contractor adaptability. Advanced financial modeling tools, for example, can simulate the impact of various economic scenarios on a contractor's cash flow and profitability, providing quantitative benchmarks for resilience. Machine learning algorithms can analyze historical data to identify patterns and predict contractor behavior under economic stress, offering actionable insights for underwriting decisions. Additionally, geographic information systems allow underwriters to assess regional market conditions and their potential influence on contractor performance, enabling a more granular evaluation of adaptability. The integration of these methodologies and frameworks ensures a comprehensive assessment of contractor adaptability, aligning risk management practices with the dynamic nature of economic conditions. By continuously refining these approaches and incorporating new data sources, underwriters can better anticipate and mitigate risks, supporting both contractor success and the stability of the construction industry in an ever-changing economic landscape. Emerging markets and growth regions present a dynamic intersection of opportunity and risk in construction underwriting, requiring a comprehensive evaluation of economic, infrastructural, and socio-political factors to navigate their complexities effectively. Identifying high-growth construction regions begins with an analysis of key drivers such as population growth, urbanization trends, industrial expansion, and government investment in infrastructure. Rapid urbanization in regions like Southeast Asia, Sub-Saharan Africa, and parts of Latin America has spurred a surge in demand for residential, commercial, and industrial construction, creating lucrative opportunities for contractors and underwriters alike. For example, cities such as Nairobi, Jakarta, and São Paulo have witnessed exponential growth, driven by a combination of demographic pressures and increasing foreign direct investment. However, high-growth regions often exhibit significant disparities in development, with some areas flourishing while others struggle to overcome infrastructural bottlenecks or economic instability, making targeted assessment critical for underwriting success. Evaluating underwriting opportunities in these markets necessitates a granular approach that balances macroeconomic indicators with localized insights. Macroeconomic stability, as reflected in metrics such as gross domestic product growth, inflation rates, and currency exchange volatility, provides a foundational perspective on a region's economic health. For instance, sustained gross domestic product growth rates above 5% often indicate a robust economy capable of supporting large-scale construction projects. However, regional factors such as infrastructure quality, labor availability, and political stability play equally vital roles in determining the feasibility and profitability of construction activities. In emerging markets, the presence of weak infrastructure, such as inadequate transportation networks, unreliable power supply, or limited access to clean water, can significantly hinder project execution, leading to delays, cost overruns, or contractor defaults. Furthermore, assessing the regulatory environment is critical, as unclear or inconsistent construction codes, permitting processes, and labor laws can pose significant risks to project timelines and budgets. Balancing the potential of emerging markets with infrastructure and economic risks requires a nuanced understanding of risk management and mitigation strategies. Underwriters must account for the unique challenges posed by these regions, including higher political risk, susceptibility to natural disasters, and fluctuating demand driven by global economic trends. Political instability, characterized by frequent changes in government, corruption, or civil unrest, can disrupt project execution and financing, increasing the likelihood of contractor insolvency. For example, construction projects in Venezuela during its recent economic collapse were plagued by hyperinflation, resource scarcity, and social unrest, leading to widespread project cancellations and bond claims. In contrast, regions with strong institutional frameworks, such as parts of Eastern Europe and Southeast Asia, have demonstrated resilience in the face of economic challenges, offering more stable opportunities for underwriting. Infrastructure development plays a dual role in emerging markets, acting as both a driver of construction demand and a source of risk. Governments in high-growth regions often prioritize infrastructure projects to stimulate economic activity, enhance connectivity, and attract foreign investment. These initiatives, ranging from highway expansions to renewable energy installations, create significant opportunities for contractors and underwriters. However, they also expose stakeholders to risks such as cost inflation, delays due to land acquisition disputes, and financing shortfalls. Underwriters must carefully evaluate the feasibility of these projects, considering factors such as funding sources, contractor experience, and the potential for community opposition. Projects backed by multilateral institutions such as the World Bank or regional development banks typically carry lower risks due to their rigorous due diligence and financial guarantees, making them attractive targets for underwriting. Case studies provide valuable insights into underwriting strategies in booming versus declining markets. In high-growth markets such as India, the rapid expansion of urban centers like Bangalore and Hyderabad has created a thriving construction sector, driven by information technology hubs, residential demand, and infrastructure investments. Underwriters operating in these markets have successfully leveraged data on local economic trends, contractor performance, and regulatory frameworks to craft competitive bond terms while mitigating risks. Strategies such as incentivizing contractors to adopt advanced project management tools or securing collateral for high-value bonds have proven effective in managing exposure. Conversely, declining markets such as Detroit in the aftermath of its municipal bankruptcy present a starkly different risk landscape. Contractors operating in these environments face reduced demand, deteriorating infrastructure, and heightened financial strain, requiring underwriters to adopt conservative approaches. In such cases, stringent pre-qualification criteria, higher collateral requirements, and increased scrutiny of project funding sources are essential to managing risk. Theoretical frameworks such as location theory and risk diversification offer additional perspectives on evaluating emerging markets and growth regions. Location theory emphasizes the spatial distribution of economic activity, highlighting the role of factors such as resource availability, transportation costs, and proximity to markets in shaping construction demand. For example, the concentration of oil and gas resources in the Middle East has driven the development of energy infrastructure, creating significant opportunities for specialized contractors. Risk diversification, a core principle of portfolio management, underscores the importance of balancing exposure across regions and project types to mitigate the impact of localized downturns. By diversifying their portfolios to include a mix of high growth and stable markets, underwriters can achieve a more balanced risk-return profile. Contemporary debates in the field focus on the ethical and environmental implications of underwriting in emerging markets. Critics argue that rapid construction activity in high-growth regions often exacerbates issues such as deforestation, displacement of local communities, and carbon emissions, raising questions about the long-term sustainability of these projects. Proponents of sustainable construction practices advocate for the integration of green building standards, renewable energy solutions, and community engagement into project planning and execution. Underwriters can play a pivotal role in promoting sustainability by incentivizing contractors to adopt environmentally friendly practices through favorable bond terms or premium discounts. Advances in technology and data analytics are transforming the evaluation of emerging markets, enabling underwriters to access real-time data and predictive insights. Geographic information systems, for example, allow for the visualization of construction activity and infrastructure development at a regional level, while machine learning algorithms analyze historical data to forecast market trends and contractor performance. These tools enhance decision-making by providing a more comprehensive understanding of the opportunities and risks associated with specific regions, enabling underwriters to tailor their strategies to the unique characteristics of each market. By synthesizing historical insights, theoretical frameworks, and practical applications, underwriters can effectively navigate the complexities of emerging markets and growth regions. This approach ensures that opportunities are maximized while risks are systematically identified and mitigated, supporting the long-term stability and profitability of construction portfolios in an increasingly interconnected global economy. Monitoring legislative and regulatory changes is a critical component of anticipating economic shocks and managing risks in the construction industry. Regulatory frameworks and policy decisions profoundly impact every stage of a construction project, from permitting and financing to material procurement and labor availability. Changes in environmental regulations, zoning laws, labor policies, and trade agreements can alter the economic landscape, introducing new challenges and opportunities for contractors and underwriters. Effective monitoring requires a systematic approach that integrates data analysis, stakeholder engagement, and scenario planning to track the evolution of relevant laws and regulations. By staying attuned to these developments, underwriters can assess their potential impact on project viability and contractor performance, enabling proactive adjustments to bond terms and risk management strategies. Legislative and regulatory changes often generate ripple effects throughout the construction industry, influencing material costs, labor markets, and project timelines. For example, environmental policies aimed at reducing carbon emissions frequently mandate the use of sustainable materials or energy-efficient construction practices. While these requirements promote long-term environmental benefits, they can also increase upfront costs for contractors, particularly in regions where access to green materials and technologies is limited. Trade policies, such as tariffs or export restrictions, similarly affect material costs by altering supply chain dynamics. The imposition of steel and aluminum tariffs by the United States in 2018, for instance, led to significant price increases for these materials, forcing contractors to renegotiate budgets and absorb unexpected cost escalations. These economic ripple effects highlight the interconnected nature of regulatory changes and the importance of comprehensive risk assessments in the underwriting process. Labor availability is another critical area affected by policy changes. Immigration policies, for example, play a significant role in shaping the construction workforce, particularly in regions where immigrant labor constitutes a substantial portion of the industry. Stricter immigration laws or enforcement measures can lead to labor shortages, driving up wages and delaying project completion. Conversely, policies that promote vocational training and workforce development can alleviate labor constraints, enhancing contractor capacity and project efficiency. Monitoring these dynamics requires a deep understanding of both local labor market conditions and broader policy trends, enabling underwriters to evaluate the long-term implications for contractor performance and project risk. Predicting the economic ripple effects of policy changes involves the application of advanced analytical tools and methodologies. Scenario modeling, for instance, allows underwriters to simulate the potential outcomes of regulatory shifts, incorporating variables such as material price volatility, labor supply fluctuations, and project financing conditions. These models can be tailored to specific policy scenarios, such as the introduction of stricter building codes or the implementation of subsidies for renewable energy projects, providing actionable insights into their likely impact on construction activity. Historical analysis further enhances predictive accuracy by identifying patterns and correlations between past regulatory changes and industry outcomes. For example, the deregulation of financial markets in the late 1990s spurred a boom in construction activity by increasing access to credit, while the tightening of lending standards following the 2008 financial crisis had the opposite effect, underscoring the cyclical relationship between policy and economic performance. Risk mitigation strategies for regulatory uncertainty are essential to maintaining stability in underwriting portfolios. One effective approach is the diversification of exposure across regions and project types, reducing reliance on markets that are particularly vulnerable to policy shifts. For example, contractors operating in regions with frequent changes to zoning laws or environmental regulations may present higher risks than those in more stable regulatory environments. By balancing their portfolios to include a mix of high-risk and low-risk markets, underwriters can buffer the impact of sudden policy changes. Additionally, the inclusion of contingency clauses in bond agreements can provide financial safeguards, allowing underwriters to adjust terms or pricing in response to regulatory developments. These clauses are particularly useful in long-term projects, where the likelihood of policy changes increases over time. Interdisciplinary frameworks further inform risk mitigation strategies by integrating insights from political science, economics, and law. Political risk analysis, for instance, evaluates the stability of regulatory regimes and the likelihood of policy shifts based on factors such as electoral cycles, lobbying activity, and geopolitical tensions. Economic theories, such as the general equilibrium model, provide a comprehensive view of how policy changes affect supply and demand dynamics across interconnected markets. Legal analysis, meanwhile, examines the enforceability of contracts and the implications of regulatory compliance requirements, offering practical guidance for structuring bond agreements in uncertain environments. Together, these perspectives enable underwriters to anticipate and adapt to the complexities of regulatory uncertainty. Case studies illustrate the diverse impacts of regulatory and policy changes on construction underwriting. In California, the introduction of stricter seismic safety regulations following the Northridge earthquake of 1994 significantly increased construction costs for both new projects and retrofits of existing structures. Contractors who proactively adapted to these requirements by investing in advanced engineering techniques and materials demonstrated greater resilience, while those who failed to comply faced project delays and financial losses. Similarly, the rapid expansion of renewable energy policies in Europe has created a surge in demand for wind and solar projects, but it has also introduced risks related to supply chain dependencies and fluctuating subsidy programs. Underwriters operating in these markets have adopted innovative strategies, such as partnering with specialized contractors and incorporating performance guarantees to manage these risks effectively. Contemporary debates in the field focus on the balance between regulatory oversight and industry flexibility. Proponents of robust regulation argue that stringent policies ensure safety, sustainability, and long-term economic stability, particularly in high-risk sectors such as construction. Critics, however, contend that excessive regulation can stifle innovation, increase costs, and discourage investment, particularly in emerging markets with less developed regulatory frameworks. This debate underscores the need for adaptive strategies that balance compliance with operational efficiency, enabling contractors and underwriters to navigate regulatory landscapes without compromising project outcomes. Technological advancements are transforming the monitoring and analysis of regulatory changes, providing new tools for risk assessment and decision-making. Natural language processing algorithms, for instance, can analyze legislative texts and identify potential impacts on construction projects, while machine learning models predict the likelihood of policy implementation based on historical and contextual data. Geographic information systems allow for the visualization of regulatory environments across regions, enabling underwriters to compare market conditions and identify high-risk areas. These innovations enhance the precision and scalability of regulatory monitoring, enabling stakeholders to respond proactively to policy developments. By integrating historical insights, analytical methodologies, and interdisciplinary perspectives, underwriters can effectively anticipate and manage the economic shocks associated with legislative and regulatory changes. This comprehensive approach ensures that underwriting practices remain aligned with the evolving regulatory landscape, supporting the stability and resilience of construction portfolios in a dynamic global economy. Forecasting long-term economic trends for multi-year projects requires an intricate synthesis of macroeconomic analysis, risk assessment, and data-driven methodologies to account for the uncertainties inherent in extended project timelines. Multi-year projects, such as infrastructure development, large-scale commercial construction, or public works initiatives, are particularly susceptible to shifts in economic conditions that can significantly alter their cost structures, funding availability, and completion schedules. Evaluating economic risks for these projects begins with a comprehensive analysis of the macroeconomic environment, focusing on variables such as gross domestic product growth, inflation rates, interest rates, and fiscal policies. Historical economic cycles provide a foundational framework for identifying patterns and correlations that may influence long-term project risks. For example, periods of economic expansion typically correlate with increased construction demand and rising material costs, while recessions often result in reduced funding and labor market contractions. By analyzing these cycles in conjunction with project-specific factors, underwriters can anticipate potential disruptions and design more resilient financial strategies. Managing inflation risk in multi-year contracts and long-term surety bonds is one of the most critical aspects of long-term economic forecasting. Inflation erodes purchasing power over time, driving up the costs of materials, labor, and equipment required for construction projects. Contractors engaged in fixed-price contracts are particularly vulnerable to inflationary pressures, as they must absorb cost increases without the ability to adjust pricing. This risk is compounded in projects reliant on commodities with historically volatile prices, such as steel, concrete, and petroleum-based products. To mitigate these risks, underwriters must evaluate the contractor's ability to manage inflation through procurement strategies, such as securing price locks, entering into long-term supply agreements, or employing hedging instruments in commodity markets. Escalation clauses, which allow for adjustments to contract pricing based on inflation indices, offer another effective mechanism for managing cost variability. These clauses must be carefully calibrated to reflect the specific economic conditions of the region and project type, ensuring that they provide adequate protection without introducing excessive complexity or risk to the contractor. Building economic trend datasets is a cornerstone of improving underwriting consistency for multi-year projects. These datasets consolidate historical and real-time economic data to provide actionable insights into long-term trends and their implications for construction risk. Key components of these datasets include historical price indices for construction materials, labor cost trends, regional economic performance metrics, and policy-driven variables such as tax incentives or infrastructure spending commitments. Advanced analytics tools, such as time series forecasting models, enable underwriters to extrapolate these trends into the future, identifying potential inflection points or periods of heightened risk. For example, a dataset that tracks regional housing demand, combined with projected population growth and mortgage rate trends, can provide critical insights into the long-term viability of residential development projects. Similarly, datasets focused on global commodity markets can help underwriters anticipate material shortages or price spikes that may impact project budgets and timelines. The historical context of long-term economic forecasting highlights its evolution as a critical tool in construction underwriting. During the post-World War II era, large-scale infrastructure projects such as highways and dams required sophisticated economic planning to account for material shortages, labor availability, and post-war economic fluctuations. The oil shocks of the 1970s further underscored the importance of forecasting and managing energy-related costs and supply chain disruptions. More recently, the global financial crisis of 2008 demonstrated the cascading effects of economic downturns on multi-year construction projects, with many contractors facing liquidity challenges and defaulting on obligations due to declining demand and tighter credit conditions. These historical lessons emphasize the need for robust forecasting methodologies that incorporate both short-term volatility and long-term structural trends. Theoretical frameworks such as dynamic stochastic general equilibrium models and input-output analysis provide valuable insights into the interplay between economic variables and construction activity. Dynamic stochastic general equilibrium models simulate the effects of shocks, such as changes in monetary policy or global trade conditions, on the broader economy and specific sectors, including construction. Input-output analysis, on the other hand, examines the interdependencies between industries, highlighting how changes in one sector, such as manufacturing, can ripple through supply chains to impact construction costs and timelines. By integrating these frameworks into forecasting practices, underwriters can develop more nuanced risk assessments that account for the complex relationships between economic variables and project outcomes. Contemporary debates in long-term economic forecasting focus on the balance between predictive accuracy and practical application. While advanced models offer increasingly sophisticated insights, their reliance on extensive data inputs and complex algorithms can create barriers to implementation, particularly for smaller underwriting teams. Critics argue that over-reliance on quantitative models may obscure important qualitative factors, such as contractor expertise, project management capabilities, and local market conditions. Proponents, however, emphasize the importance of leveraging data-driven tools to reduce subjectivity and enhance decision-making consistency across underwriting portfolios. This debate underscores the need for a balanced approach that integrates quantitative rigor with expert judgment and contextual knowledge. Interdisciplinary connections further enrich long-term economic forecasting by incorporating perspectives from behavioral economics, geopolitics, and environmental science. Behavioral economics explores how contractors and stakeholders respond to economic uncertainty, such as through risk aversion or over-optimism, providing insights into decision-making dynamics during extended project timelines. Geopolitical analysis evaluates the impact of international trade policies, currency fluctuations, and regional conflicts on material availability and cost structures. Environmental science highlights the increasing importance of sustainability considerations in construction, such as the transition to low-carbon materials and renewable energy sources, which may introduce both risks and opportunities for multi-year projects. Advances in technology and data analytics are revolutionizing long-term economic forecasting, enabling underwriters to access real-time data and develop more precise risk models. Machine learning algorithms can identify patterns and correlations in large data sets, uncovering insights that may not be apparent through traditional methods. Geographic information systems allow for the spatial analysis of economic trends, such as the distribution of infrastructure investments or the impact of climate change on regional construction activity. Blockchain technology offers potential applications in supply chain transparency, providing underwriters with real-time visibility into material procurement and pricing. These innovations enhance the scalability, accuracy, and relevance of long-term forecasting, empowering underwriters to navigate the complexities of multi-year projects with greater confidence. By synthesizing historical insights, advanced methodologies, and interdisciplinary perspectives, underwriters can refine their approaches to long-term economic forecasting, aligning risk management practices with the evolving demands of multi-year construction projects. This integration ensures that underwriting decisions remain grounded in a comprehensive understanding of economic dynamics, supporting the stability and success of large-scale construction initiatives in an increasingly uncertain global economy. Integrating market intelligence into surety bond pricing represents a sophisticated convergence of real-time data analysis, economic modeling, and underwriting expertise to create pricing strategies that accurately reflect market conditions while balancing competitiveness and risk. Real-time market data, including regional construction trends, commodity price fluctuations, labor market conditions, and contractor performance metrics, forms the foundation of dynamic bond pricing models. This data allows underwriters to identify shifts in demand, assess regional economic health, and evaluate the cost pressures facing contractors. For instance, an unexpected spike in steel prices driven by global supply chain disruptions would necessitate an adjustment in bond pricing to account for heightened project costs and potential contractor financial strain. By incorporating these market signals, bond pricing models become more agile and reflective of current economic realities, enhancing their predictive accuracy and relevance. Collaboration with construction economists and data scientists is essential to extracting actionable insights from complex datasets and enhancing the predictive power of bond pricing models. Construction economists provide valuable macroeconomic and sector-specific expertise, interpreting trends in infrastructure spending, housing starts, and commercial development to forecast future market conditions. Their insights are particularly critical in understanding cyclical patterns within the construction industry, such as the impact of fiscal stimulus on public works projects or the effect of rising interest rates on private sector investment. Data scientists, on the other hand, bring technical expertise in statistical modeling, machine learning, and data visualization, enabling the analysis of large, multifaceted datasets to uncover correlations and trends that may not be immediately apparent. For example, a machine learning algorithm could analyze historical contractor performance data alongside economic indicators to identify early warning signs of potential defaults, such as declining profit margins or delayed project completions. This interdisciplinary collaboration not only enhances the precision of bond pricing, but also supports the development of proactive risk management strategies. Developing market-driven underwriting guidelines involves translating market intelligence into actionable frameworks that guide bond pricing and risk assessment. These guidelines must strike a delicate balance between competitiveness and risk mitigation, ensuring that bond premiums are both reflective of market conditions and sufficient to cover potential losses. For instance, in a booming construction market characterized by high demand and robust contractor performance, underwriting guidelines might prioritize competitive pricing to capture market share while maintaining rigorous pre-qualification criteria to safeguard against overextension risks. Conversely, in a contracting market with rising defaults and cost overruns, guidelines would shift toward more conservative pricing and enhanced scrutiny of contractor financial health. This adaptability requires continuous monitoring of market conditions and a willingness to recalibrate underwriting strategies in response to new data and trends. The historical evolution of surety bond pricing highlights the growing importance of market intelligence in underwriting practices. In the early 20th century, bond pricing was largely static, relying on standardized rates and qualitative assessments of contractor risk. However, the increasing complexity and scale of construction projects, coupled with the volatility of modern economic conditions, have necessitated a shift toward data-driven dynamic pricing models. The financial crises of 2008 and the disruptions caused by the COVID-19 pandemic underscore the critical need for real-time market insights to anticipate and respond to sudden economic shocks. These historical lessons illustrate the value of integrating market intelligence into bond pricing to enhance resilience and adaptability in an uncertain global economy. Theoretical frameworks such as dynamic pricing theory and behavioral economics provide additional depth to the analysis of market-driven bond pricing. Dynamic pricing theory emphasizes the importance of flexibility in adjusting prices based on real-time supply and demand conditions, enabling underwriters to respond swiftly to market fluctuations. Behavioral economics, meanwhile, explores the decision-making processes of contractors and project owners, shedding light on how pricing strategies influence bidding behavior and project selection. For example, contractors facing tight profit margins may prioritize projects with lower bond premiums, even if these projects carry higher operational risks. By understanding these behavioral dynamics, underwriters can refine pricing models to align with market incentives and contractor priorities. Contemporary debates in the field revolve around the balance between transparency and competitiveness in bond pricing. While greater transparency in pricing models fosters trust and collaboration between underwriters and contractors, it also risks revealing proprietary methodologies and market strategies to competitors. This tension highlights the importance of leveraging advanced data analytics to develop pricing models that are both transparent in their rationale and robust in their execution. Proponents argue that transparent pricing builds long-term relationships and enhances market stability, while critics caution against overexposure of competitive intelligence. Technological advancements are revolutionizing the integration of market intelligence into bond pricing, providing underwriters with new tools for data collection, analysis, and application. Real-time dashboards powered by artificial intelligence aggregate data from diverse sources, such as economic reports, industry publications, and contractor performance databases, offering underwriters a comprehensive view of market conditions at a glance. Predictive analytics tools enable the simulation of various economic scenarios, such as the impact of a sudden labor shortage or a prolonged increase in material costs, allowing underwriters to assess the potential implications for bond pricing and portfolio risk. Blockchain technology offers additional opportunities for enhancing transparency and efficiency in the underwriting process, enabling secure, real-time sharing of project data and contractor performance metrics among stakeholders. Interdisciplinary perspectives further enrich the integration of market intelligence into surety bond pricing by connecting construction underwriting to broader economic, social, and technological trends. Urban economics provides insights into the spatial dynamics of construction demand, highlighting the importance of regional factors such as population growth, infrastructure investment, and housing affordability in shaping market conditions. Environmental science emphasizes the growing influence of sustainability considerations, such as the transition to green building materials and renewable energy sources, on construction costs and risk profiles. By incorporating these perspectives, underwriters can develop pricing models that are not only market-driven, but also aligned with broader industry and societal goals. Through the integration of real-time market data, interdisciplinary collaboration, and advanced analytics, underwriters can refine surety bond pricing strategies to reflect the dynamic nature of the construction industry. This approach ensures that pricing models remain responsive to market conditions, supportive of contractor success, and resilient in the face of economic volatility, fostering stability and growth within the surety industry and the broader construction sector.